will talk about bubbles in the markets with the model of the risK-Yield discriminant optimization, the KYDON solution. I'm Nikos Loukeris, some professor from the University of West Attica. So, the bubbles in the markets can put in grave hazard the growth of the economies. Investing momentum and manipulation can easily distort expectation in irrational levels. The risK-Yield discriminant optimization, KYDON, optimizes portfolio selection in a volatile market, neutralizing exposure to extreme events, that is, bubbles and bursts. New approaches of chaos dynamics, behavioral welfare, and optimal AI classifiers on the KYDON improve the optimal investment policy. KYDON detects potential bubbles, preparing its burst under expectations of long growth, and reduces the impact of systemic risk. KYDON performs as a dragon slayer, eliminating the loss of investors. The market fluctuations are strengthening in periods of instability, as economic and geostrategic frictions usually produce clashes. Distinct groups of interest seek to dominate markets on their agenda. This imbalance of interest supports a plethora of irrational expectations. Future returns tend to be inadequately priced rather than the evaluations of current models. Policymakers and fund managers detect these instabilities, investing in bargaining bubbles, collecting overpriced securities, and sell them later on overvalued prices and extreme profits, contradicting the markets. I introduced an analytical model, risK-Yield discriminant optimization, KYDON, inspired by my previous models, Heracles and PIR, and my past model, EPICO, that outperformed S&P 500 by 7.5%. I extend my research in the KYDON to act as a dragon slayer that protects investors from exposure to clashes and follow bubbles as extended tools in terms of gain and pain that are incorporated with the advanced prospect of chaotic entropy, fundamental filtering, investor sentiments, and behavioral welfare to optimize investments. I analyze 40 modular networks on 10 neural and 30 hybrids, 6 support vector machines on 2 plain SVMs and 6 hybrid SVMs, all on multiple topologies to define the best classifying portfolio selection. So, this research aims to provide an efficient tool to incorporate the detailed behavioral preferences of investors to contribute to the portfolio theory, elaborating hidden data of accounting statements and sentiments of investors on fundamentals, minimizing bias, selecting the healthy securities in some stratum of chaos and fractal market hypothesis, and to evaluate modular and SVM networks in various forms of neural or hybrid systems to have the best classifier in portfolio selection. Now, the exuberance in the markets is by free will. Excess volatility periods is a usual pattern in the markets, producing overpriced and underpriced assets. Thus, slots of exuberance emerge probabilistically. The core of this research is with KYDON to decrease exposure on excess volatility without neglecting the growth opportunities in the market. Higher welfare opportunities are attainable simply by complicated than plain linear processing. Physical logic optimizes the usefulness and behavioral well-being of investors. The induction of Aristotelian logic and the hedonistic serene Epicureanism elaborated were emphasized that usually routine behavior alters to dynamic logic aiming superior perspectives. The investors are more interested on their potential losses, and the market chaotic dynamics can support more efficient investments. The returns advanced moments have detailed aspects on the behavior of investors on risk-averse of absolute hyperbolic utility, HARA, that can be defined in this formulation. Regarding the precision of risk preferences, the level of risk aversion, and the HARA isoelastic utility has this well-known form. Now, the Markowitz model as a quadratic utility from the 1952 is defining this formulation in 3. So the fractal distribution is a probabilistic similarity distribution over its parts and the whole in different scales, and the natural phenomena in the markets. Two fractal indications are created, the fractal expectation and the fractal variance. The fractal expectation, Ex of I, is the ith random variable xi as follows. That is described in the equality 7. Now, the variance is given in the equality 12. Now, the portfolio of P assets with weights omega, and the return of the asset is the R, resolves the weights of omega, and maximizes the risk-return balance in this formulation. Now, the MTP and the model create a portfolio on fractal expectation and fractal variance as EF over I is equal to EI and the fractal expectation of the assets. The fractal variances of assets and the portfolio and the return are given as follows. Now, the Lagrange solution on the optimal portfolio of the fractal expectation and variance is given as follows. The markets. Speculating investors decide dynamically on their positions for the risk-free bonds and the treasury bills and the risky stocks. The securities are traded by 3 types of investors: the chartists or noise traders, the fundamentalists, and the dragon slayers. The chartists or noise traders invest in social mimicking and price momentum. The fundamentalists are logical risk-averse investors that maximize their expected utility on wealth in constant relative risk aversion, CRRA utility. And the dragon slayer investors thinks to fight bubbles and bursts on risky securities. The risk-free security treasury bill or bond has elastic supply paying a fixed RF return. The risk security for price P in time T has endogenous equilibrium of demand and supply, and if the year was profitable, pays a dividend dt of discrete stochastic growth as follows. And the excess return is given in the 22 equality. The fundamentalists put a portion of their wealth on the risky stock and the rest on the bond, maximizing expected utility in CRRA. Myopically update new information over risky stock and dividend. The charges evaluate historical data comparing to other charges opinions and invest in the risky security or treasury bill. Other dragon slayers trade risky securities predicting bubbles and crashes, make the expected return, uh, evaluating potential bubbles, expecting the meltdown to maximize the expected utility, similar to the fundamentalists. Further higher moments have more details on investors' behavior. The bubbles and the dragon slayers are affected, given that the Dragon Slayer can success return momentum YT above the long return in exponential moving average with memory parameter alpha in time t minus 1 after the return of t minus 1 is calculated and distributes the future investments of securities. The noise traders use the price momentum H, and the YT is more sensitive to accelerations of the price. Thus, Dragon Slayers have the probability that overvaluation will cause a burst by the logistic function. The expectation of returns is given as follows, and the direction of the bubbles follows a time window in scale 1 divided by 1 minus alpha. Now, the KYDON is applied by the best classifier from the current research, the modulars and the support vector machines with hybrids that are acting like Dragon Slayers. The modulars are feed-forward networks, a version of MLPs that process input in parallel multiple MLPs, distributing the incomes, forming a predetermined set of topology, and the intermediate layers to specialize the function of each submodule. I use the linear feed-forward of no bypass from the four modular topologies that are available. And opposing the MLPs, all MDNs are fully interconnected among the layers, and with lesser weights are to be necessary for a similar size network. And they boost the learning in lesser training exemplars. Each module isn't sure that we specialize the learning data single parts. 16 neurons are the inputs for upper neurons on the hidden layers. Tan-Haxon is an upper transfer function. The lower neurons were without genetics. The Tan-Haxon for the lower transfer as well. And the learning rule is the momentum. The step size is 0.1 and 0.7 is the value of the momentums in the backpropagation learning rule with 706 exemplars and 1 output. The correction is the learning rule in supervised learning control of 1000 maximum epochs. Determination is on minimum mean square error of 0.01 threshold, and the minimum criterion was load based on test and the batch learning. This is the hybrid MDN with genetics and cross validation on the hidden layer only. Now, the support vector machines use categorical labeled training input data to create classification aggregation binary entities output. The training is limited in a sequential minimal optimization, as the output is unmarked and needs a slow training process in vast multi-class data. The SVMs minimize their computing needs of multi-dimensional space through direct process of inputs. This is the support vector machines. And the problem is that the utility of investors are given in this way, and the inductive logic of Aristotle and the aponia hedonism of Epicurus agree to the core objective function of the model, the minimization of risk in all its detailed forms that are expressed in higher moments. So the previous problem can be rewritten in this way, as in 36, considering also the health of the assets. So the non-convex solution surface needs robust computing, and risk securities with chaotic dynamics involve the stochastic differential equation of that is given in the next quality. The excess return of the optimal risk is given as follows. Those utilities optimized by equality 42 or it can be written as a function of minimum forms of risk. The KYDON is given in this flowchart. It acts as a dragon's lair, trading the risk security to protect from classes and bubbles. Gets the expected return, examines the boom probability by fraudulent practices in the markets, preparing for meltdown, filtering the long-term growth, ERI, and optimizes EU, expected utility, like the fundamentalists. The data came by 1,411 companies from the Loan Department of a Greek bank in 16 financial indices according to the Kurt's methodology of 78, like EBIT to total asset, net income to net worth, and so on. And the 17th index was the initial classification by bank executives. The set was 50% of overall data and training 50% as well. So many different networks form plain or hybrid MDN and SVMs, like the MDN neural nets, the hybrid MDN in genetics, alone over the input layer, and so on. The results: the MDN systems had a more reliable efficiency overall. The hybrid MDN of genetics and the two hidden layers had the highest performance and classification fitness of the model to the data, the R, but high computing time, and it was the best MDN system. The second rank was given to the MDN of the three hidden layers, cross-validation, adequate and with adequate classification, errors and good performance, and higher partiality on significant computational time. I have to mention that although SVMs had overall superior results, they expose very high partiality and thus they cannot be considered robust and reliable classifiers. Their better classification and performance is neutralized by the very high values of partiality and those they are exposed to overfitting and lower reliability. The third place was given to SVM of 500 epochs optimized by genetics on the inputs only and cross-validation. So these are the optimal models. We can see clearly that the MDNs were superior in terms of integrity, with a bit inferior classification and error results than the SVMs, but the impartiality aspect is a very important parameter. All the SVMs suffer from this very high partiality aspect, which makes them not attractive. So the conclusions is that the best classifier on the KYDON system is the hybrid MDN with genetics of in all layers of two hidden layers as well. The intuition of investments under a triple filtering of the market data, chaos accounting, and sentiments combines hidden information process and optimize the portfolio per investor to the highest appropriate financial welfare. And only the wealth aspect is insufficient to describe the overall needs of each investor. In terms of the portfolio optimization, the integrated system KYDON acts as a dragon slayer, trading the risky stocks to predict and avoid crashes and bubbles in the optimal hybrid MDN classifier. KYDON diagnoses the possibility of the bubble because of fraud, hoax, or manipulation, anticipating the drawdown of its burst and the expectations of the long-term rate. The superior classification accuracy of the hybrid MDN with two intermediate layers comes at the cost of growth on computational terms, which may limit its practicality for real-time portfolio management. Thank you very much. Any questions?